What's going on, guys? Daniel here from Miracle Trading. In today's video, I'm going to be covering the topics finding your edge, risk management, and funded accounts. So I have covered these topics all together. It's going to be a whole guide in this video, so you guys would not need another video or anything else in order to be a profitable trader. So this is going to be the whole A to Z. So first of all, let's start with building your edge. So we as a trader, when we start a trade, we see all these strategies, all these concepts, all these models. So it's important to stick to one of them, stick to one model, stick to one strategy. I don't care if you trade support resistance, supply and demand, trend lines, whatever you trade, I don't care, but just stick to one thing. Keep it simple. Stop strategy hopping. Stop going from mixing other strategies into making your own formula. Just stick to one thing that suits the best for you, that works the best for you, that works the best with your own personality. All right, so we wanted to keep it simple, and you have to know what works for you, what you have to know what you want, as well as we have here a healthy trading routine and journaling. So when we're saying sticking to one model or strategy, let's say, so for example, if you trade ICT here, you can stick to the 2022 ICT mentorship, which is very safe, very simple, easy to understand. It's very well suited for a beginner trader. We have the unicorn model, which is also safe and simple. This model occurs almost every single day. You can find these setups every single day across all of the Forex pairs and indices. We have the market maker buy model and the market maker sell model, which is more advanced and is also universal. So this also works across all the Forex pairs and the indices. We have the ICT optimal trade entry model, which I do recommend it for Forex. So if you're trading Forex, the Forex market, I recommend you to trade this model. It could be any other model, but this is just an example. We have the silver bullet, which is time-based, universal, safe, and simple as well. We have also the ICT turtle soup, which is again more advanced. It could get complicated sometimes by longing every swing low that is taken or shorting every swing high that is taken, but it is a high RR model or strategy. Principles to your trading model. So these are some principles that should be included in your trading model. Whatever your trading model is, based on, if you trade ICT, for instance, you should include these principles. So we have the first one, which is daily bias. Know your higher time frame direction or trend. So it's important to know where you're trading. You have to know the higher time frame direction in order to be with the trend, in sync with the trend. You have to be in rhythm with the market. When you are against the daily bias, when you're against the daily direction, every setup you see is not going to work. And this, again, is where traders think their model or strategy doesn't work. Have a clear draw on liquidity. You should see clean highs, equal lows that are clear or clean to target an obvious, again, clean and obvious price action. For instance, don't trade the Asian session. I do recommend you guys to trade the New York session based off your personality, based off your strategy. You can, of course, trade Asia, London, or whatever you like, but me, is my own knowledge and experience, I recommend you guys to trade the New York session if you're trading ICT concepts. The economic calendar is also important because this is where you know how to map your week, the weekly profile. This is where you know when to trade, when not to trade, which days to trade, and what to anticipate. So we have confirmations for your trade setup here. It is important as an ICT trader to have these points included in your trade setup in order for it to be a valid or a good trade setup. All right, so first of all, we have a liquidity sweep. A liquidity sweep is very important to your trade setup because this is the first point that comes in your checklist in order to take a trade. Me as a trader, I do not have a trade without a liquidity sweep. A displacement, we need to see clean and clear displacement before trading our trade setup. So this is another confirmation. Displacement, we need to see an energetic candle market structure shift or market structure break. Premium discount array, for example, AVG, this is where the entry comes in play. So we need to have an entry, any PD array you like, for example, fair value gap, which is the most common and the easiest one. SMT divergence, this one is my favorite, and in my opinion, one of the most important confirmations. If I would grade these 4 or 5 confirmations, I would say SMT divergence is as important as a liquidity sweep. So if we do have a liquidity sweep on another correlated pair, for example, the S&P 500, if that takes out the liquidity and NQ doesn't, this is a valid trade setup, for example. So we need to have the SMT divergence before we enter a trade. And also another point which I forgot to write it down here is premium and discount of the range. Know where you are in the range. Don't be longing premium or shorting discount. Okay, we need to know where we are in the range based off discount and premium. The trader's expectancy equation. So this equation right here is very important, and I don't see a lot of traders talk about this because this simplifies how easy trading is, how simple trading is, but we're just making it hard for ourselves. So this tells us that you don't need a 90% win rate to be a profitable trader. The formula for profitability, as you can see, this is the equation for the expectancy equation, and we have the average win, your average profit in R, for example, if you have a 2R or 3R, and average loss if you always lose 1R, if you're disciplined, 1R or 2R, all right, doesn't matter. So if your expectancy score is greater than 0, you have a money printing machine, meaning your model, your strategy is profitable. If it's less than 0, you're just gambling, no matter how good your fair value gaps look. All right, so let's say, for example, we have a 50% win rate with a risk to reward of 1 to 3, meaning we're risking $100 to make $300 with a win rate of 50%. So the math is going to be like this: 0.50, because we have a 50% win rate, we're going to take 0.50 times 3, which is our average win, which is 3R, and we're going to minus that by 0.50. Again, this is our average losing because we have a 50% win rate. We're going to time that by 1, and we're going to minus this, and we're going to minus this with this, which gives us the expectancy equals 1.5 minus 0.5 equals 1. Now we're above 0. Everything above 0 is profitable. Healthy trading routine and journaling. Preparation, warm up your brain, warm up your mind. Preparation is very important because trading is a performance game, is not like any other skills out there, right? So this is our outcome is based off of our performance. So it's very important to warm up our mind, warm up our brain before we take a trade. So we have to be on the charts early. We need to build a healthy routine, be on the charts early. We have to treat it like a business. We have to write down our emotions. We have to write down the purposes of the trades that we take, and we have to write down our mistakes and what we handled well. What I recommend is using a Notion template, for example, or just write it down on a piece of paper, or just have a journal in a form of a notebook. So me personally, what I do is I have a Notion template where I'm writing down my emotions, why I'm taking the trade and all that, with everything sorted out with the preparation, what I want to see, what I'm looking for and all that, what I did good, what I did bad, what I should work on, what I should don't care about and all that. So I have a Notion template that I'm using every day. Now let's jump to the math of a fund account. So we have the drawdown trap, which is this right here. If you're having a 50K fund account, you're not having $50,000 to trade with because the drawdown is $2,000. So you're not trading with a 50K account, you're trading with a $2,000 account. So you're not going to be risking based off of the $50,000 that you're seeing. You're going to be risking based off of the drawdown that you have, which is $2,000. So there's now a difference between risking 1% and 0.1%. So when you're risking 1%, you're risking 1% of the $50,000 account. So now you have, if you're risking $500 per trade, you have now four losing trades, and you have now blown the account. So you have to be careful of how much you are risking. So you're not going to be risking 1% of the 50K account, of the $50,000 that you're seeing. You're going to be risking based off the drawdown that you have. If you're going to be risking 10%, that is $200. So now you have 10 losing trades before you blow the account. Now we have the rule of two, taking two trades. All right, so this is if you're a disciplined trader, taking two trades a day. If both of them are a losing trade, then you stop. You're done for the day. You're closing your laptop. You're turning off your computer. If you have a winning trade, you're stopping. You're not going to take more than one winning trade, and you're not going to take more than two losing trades, because you're going to lose a lot if you're going to trade more than this amount. So you need to be a disciplined trader and not taking more than two trades or more than two setups. Me personally, I like to have plan A and B slash trading two setups. So instead of taking two trades, I like to have two setups, but most of traders like to take two trades. So if this works for you, you should stick to it. If not, you can try to take two setups. For example, what I do is, for example, I take two losing trades from the first setup, and then I take two losing trades from the second setup. Then I'm done for the day. I'm then risking less than a trader that is taking only two trades per day. So it's basically just the same when we're comparing it mathematically. So you should have logical stop losses and have realistic goals and targets and try to be consistent. What I want you to do is forget the 1% rule. So I see a lot of traders, I see a lot of influencers out there. When they're talking about risk management, they always mention the 1% rule. I want you to forget the 1% rule for now. Why? Because we are traders. And as a trader, trading is so open. And when trading is so open, we're all humans. And when we are all humans, we're all different. So you should use something that works the best for you and not just stick to something that works for someone else. Me personally, the 1% rule, I don't do that because it does not work for me. If it do work for you, I'm fine, stick with it. If not, you should look at trading as it's a personal thing. You should work with things that works the best for you. And as I said, the 1% rule, me personally, I don't believe it. I think traders should do their own risk management based off their own personality and their own trading strategy and models. So let's take a look at this. We have contract size and risk threshold. So we have three boxes right here, as you can see, one with red, blue, and green. The one with red says losing too much with 6 contracts. So now, no matter the numbers, this is just an example. So just imagine your own number right here when you're taking a trade with that amount of contract and you're losing too much. So for example, let's say that is 6 contracts or micro contracts. Doesn't matter. You just need to get what I'm talking about. Just get the example. So you're losing too much when you are trading with 6 contracts. All right, so you put a lot of risk to your account and your trading. And when you are trading with one contract, you're winning too little. You're not winning much. All right, so let's say here you're losing $600 when you're trading with 6 contracts in a single trade. And in a single trade, when you're trading with one contract, you're winning $100. You have to try to find that sweet spot. How do you do that? Of course, by experience, by if you know yourself, you have to know your own personality, your own model, and your own trading. So for me personally, let's say when I'm trading with 6 contracts, it's a lot for me now. I need to scale down in order to find this sweet spot of being in the middle. When I'm winning, I'm winning enough, and when I'm losing, I'm not losing too much. All right, so let's say that comes at 1 to 4 contracts. All right, so when I'm trading with 4 contracts, when I'm losing $150, and when I'm winning $500, which is the sweet spot. So now you should, as I said, when you're trading with a 1% rule, you might end up right here. You might end up right here if you're going to be trading with the 1% rule. This is what to do and what to not do when you're live on your fund account. So I'm not talking about the the first phase of your fund accounts where you need to reach this amount of money to be able to get a payout. All right, so for this is for the when you get the live account. This is after you pass your fund account. So this is what you should do. You should use minimum contract of 1 and you should use maximum contract of 3. Again, going back to this right here, you can adjust these contracts as well. So this is for me personally. What I like to use is minimum 1 contract and maximum 3 contracts. So what you should do is you should cut risk after a loss. Let's say your first trade was 3 micro contract. Don't take 4, don't take 5, take 2. Cut it. All right, take 1 or 2. After 5 winning trades, either you trade 1 contract or you don't trade at all, or you paper trade. Why? Because when you're trading, when you're on a 5 winning streak, your ego boosted. So when you're taking a losing trade, you're going to fall off if you're not a disciplined trader. All right, so this is very normal as a human. We are boosting our own ego after this 5 winning trades without us noticing. So what you should do, all right, I've been trading, I've been getting 5 winning trades, 5 winning days, 5 winning streak. Now I need to take a break, because you'll get this euphoric thinking that you can't lose. Now you think every trade you're going to take is going to be a winner because it's in your subconscious mind now that you can't lose. All right, so what you should do is now move to 1 contract, because then if you're gonna lose, you're gonna lose a very small amount of money, which is not going to affect your psychology. But if you're to trade with 4, or 5 contracts, and you see, for example, $300-$400 lost there, and then you're going to revenge trade, try to get the winning streak back. After 5 winning trades, either stop trading, either paper trade, or trade 1 contract, so we don't face revenge trading or over trading, or so you don't fall off. What you should not do is don't move your stop, don't add more contracts when you're not in profit, don't use more contracts after a loss, don't scale up after a losing trade. So coming back here, cut risk after a loss. Do not add more position, do not add more contracts after a loss. Just keep it simple. This is just a basic rule, and you should be able to follow it in order if you want to get a payout. This right here is how our trade management should be, and how to take partials. Take partials at obvious buy side and sell side liquidity pools. Take partials at PD arrays, at discount and premium, new day opening gap and new week opening gaps, and all the other stuff that you're knowing and where you feel for taking a profit. Trade management. Don't be afraid to add to your position, meaning pyramid. Don't be afraid to pyramid, because this is where you're going to get that growth very quickly and without risking. For example, you're taking a trade of 2 contracts, you're now in profit, it goes in your favor. Add 1 more contract, don't add too much, add 1 more, add 2 more, but your first position need to be at break even before adding your next position. For me, the rule is like that. You can of course change the way you like it. Trail your stop as the trade goes in your favor. You want to trail your stop as the trade goes in your favor, because you want to have these small losses. If you're a lot in profit, go break even. You should also make your own rule around this one right here, because it depends how you're trading based off of your model. It's going to depend of that. All right, so the payout. You need to have a monthly, weekly, and daily goal. Right, so you need to have a plan. You need to have a system that you're going to be following every single day in order to get this payout. You're not going to come to the charts. Let's say you're coming to the charts today and you're taking a trade and you don't know how much you're gonna make. You need to have a monthly target. You have to have a monthly goal. You have to now plan the whole month. How will you do that? So for example, let's say you need $2,600 in order to get the payout. So we have a month, which is 30 days. We have 4 weeks in the month. So if we divide 2,600 by 4 weeks, gives us $650 weekly in order to get the payout. So we need $650 in profit every week for 4 weeks to get this profit in order to get the payout. So if you're going to trade the whole 5 days, you will be needing $130 for 5 days without losing. If you're going to trade 4 days, you're going to need $162 for 4 days without losing. If you're going to trade 3 days, you're going to need $217 for 3 days without losing. So me personally, I like to trade 3 to 4 days, and I include a losing or 2 losing days, for example, and I will reach my weekly goal and I'm going to stop trading for the week. All right. So this is so much easier than it looks. All right. So because if we set these small targets, these small daily targets, which is very easily achievable, you will see the outcome, and the outcome will surprise you. Okay, because let's say here you're targeting $217, but you take a trade and you're able to get that $300, and you're going to be reaching the weekly target much easier than you think, and the monthly target much easier than you think. So what I mean by this is you need to have a plan for your payout target, to have a plan, and you need to stick to it. Okay, so when you get the live account, it is very important to have a good head start, because it's going to affect your psychology a lot. So if you, let's say you have the account fresh and you start taking a losing trade, or you start the account with a losing day, so this will affect you. So try to be very patient, try to be very clear-headed when you're taking that first trade or the first day of your funded account. Also, be cautious of the consistency rule and trade with fixed contracts, as we talked about earlier in the previous slides, trading with minimum 1 and maximum 3 contracts. When you're in a winning streak, don't get euphoric, stick to the plan and size down. What I mean by this is, let's say after the 5 winning days or the 5 winning streak, size down to the minimum contract, which is 1. So we don't fall off right here. And if you're on a losing streak, let's say you had a good head start and you take a losing trade, don't panic. Just be normal, just be disciplined, stick to the plan, size down, trade with a minimum contract until you get back to break even, which is right here. And if you're taking a trade, let's say on this day you're taking a trade and you're back up break even on that day, close the trade immediately, no matter what you see, no matter if there is clean targets, clear liquidity, clear whatever just close the trade break even no matter what. All right, so this is going to help you a lot. So don't panic, stick to the plan, size down, close the trade, break even no matter what, so you don't fall off right here. Because when you get back to break even, now your mind is clear. Now you can trade with a clear mind the next day and everything is going to be good. So I want to explain the consistency rule, because most traders do not know this, or they're not aware of this. They just trade and then maybe they get denied, or they make too much, or they don't know how much to make every day. So as we can see, we have a bunch of profits made right here. We have $300, $140, we have $60 and $485. So if we add all of these, we get a total of $985. If we take a look at here, our best day, which we made the most in these 4 days, is $485. So now we take $485. If we have a consistency rule of 30%, we're going to divide $485. We're going to divide that by 0.3, and we get this number right here. This is how much that is going to be needed to be made in order to be able to get a payout. If the higher the amount, the more you need to make in order to be able to get a payout. So if the consistency rule of your prop firm is 50%, you just do 0.5%. Now this is in total how much you need to make in order to get a payout. And now in a single day, so now since we have all of these right here and we added all these, we have a total profit of $985. And we're going to time that by 0.3, which is the consistency rule, and we're getting $295.5. We cannot make more than this in a single day. If the consistency rule is 50%, we're just gonna change the 3 to 5. It's gonna be 0.5, 985 times 0.5, and we're get a number. We cannot make more than that number in a single day. Thank you so much for watching. I hope you found this video helpful. If you did, leave a like and subscribe. Until next time, stay safe.